Good morning, good afternoon, and good evening, and welcome to another MK Ultra Live Analysis. I intend to provide content every Sunday with the MK formula broken up into three main points. Number one, market structure. Number two, past, present, and future economic data points. Number three, market sentiment. Here we have the S&P 500, which is a benchmark risk on leverage asset. I've plotted orange lines to represent the Trump administration or Trump tweets that have created unexpected jolts in the market, as well as pink lines that represent FOMC or Powell or any Fed-related jolts in the market. These are important doldrums to remember and to understand, especially when they get closer together. Notice that price action volatility increased. Moving forward into the week ahead, we can take note of several event risks that are scheduled, but we should also take extra note of unscheduled event risk. Alternatively, the current rhetoric from China and the US has remained the same. What has not changed is the fact that the USD CNH remains above 7. And as long as the USD CNH remains above 7, we are still in a volatile, unexpected risk event environment. When you look at the continuous tweets and the continuous rhetoric from China, nothing has really changed, and one can note that the market has acknowledged that. And this past week, although we saw movement, it was not as drastic as what we've seen in the past. And that is something that you should qualify as a structure that needs to be used for your qualifications. Looking at crude oil, we can see that the pink lines represent U.S. oil tanker news. This one in particular is the drone attack. We can see that we had a false breakout into a moment of indecision between these events here, and then once again, a decline right back to where we started. Reiterating that fundamental hardline data is the key driver no matter what global geopolitical risks happen. But in the near term, when you're day trading, you need to be aware of these risks. More risks ahead. We have the FANG members testifying in French court of law tomorrow at an undisclosed time regarding 3% taxes that have been placed on their businesses for any revenue coming from French customers. Now, if FANG were to leverage the U.S. administration, we could see a uptick in discussions regarding auto tariffs and Euro trade tensions. Here we have the auto manufacturers ETF, and looking at the euro, we continue to see a downtrend that tells us there is no quantitative there is quantitative easing in the future, and that is what Trump wants for the dollar, and he has said that, and the Fed has done their best to react with no need to push the markets, because monetary policy is not about the markets. Now, back to oil, it should be noted that OPEC lowered its demand for 2019 to 1.1 million barrels per day, while the 2020 forecast stayed at 1.14 million barrels per day. Global growth has slowed. Looking at the liquidity in the market during August, it's typically a very quiet month. So when we see volatility in a quiet month, it leads to unexpected risk and jolts. And that is a part of the structure that I have again reiterated that you need to take note of, because the more that people begin to unwind and de-risk and start to move to things like gold and silver and treasury bonds, the more that this market becomes less and less liquid within risk-based assets. The stock market becomes less and less attractive. Now, looking at monetary policy and the structure that has been placed in front of us for this week, it's a correlation that I would like to point out. And it should be known that in Japan in the 1980s, an overconfidence in the loosening of monetary policy led to an aggressive speculation in stock prices and real estate, pushing prices of the assets to unimaginable levels. From 1985 to 1989, the Nikkei stock tripled to more than 39,000 and accounted for more than 1/3 of the world's stock market capitalization. The ultimate bubble of wealth. Soon after the bubble plunged, nearly 50%, 39,000 to 20, and then to 15, all in just a few years. That is an important thing to understand because monetary easing and a over-leverage, a over-inflation led to that bubble, a melt-up, if you will. The US 10-year 3-month is in the news now, the inverted yield curve. It's been in negative territory for quite some time. The 10-2 flipped negative last week, which is the reason for the decline that we saw post the delay of tariffs on consumer goods for holiday shopping. And these are important indicators, but it should also be noted that the more these enter the mainstream media, the more it creates a structure of unexpected risk. Okay? And stimulus and monetary policy are ongoing themes that you should keep in mind for the long term, not just the short term. Here we have the perception of dovish to hawkish amongst central banks, and you can see that Japan is the most dovish monetary or central bank in the world, and the euro stands right behind it. And I believe that the Federal Reserve would like to keep themselves from becoming that due to the implications that a devaluation of the US dollar could have on global markets that rely on the liquidity and the value of the US dollar. It should be noted that last week we received news from a ECB central bank member ECB member, a European Central Bank member, that basically said that the intention of the central bank was to continue pushing business growth amongst their economy, and a devaluation of currency, although it wasn't outright stated, was likely in order. And if that were to occur, on top of the unsettling concerns with France and tariffs that could provoke the administration to reinstate those euro tensions, it leaves us with a very intense and difficult structure to trade. But that is the structure nonetheless. Now moving forward, number 2, economic data, past, present, and future. Now I'm not going to get into what has happened because you should know, but moving into the week ahead, we have the FOMC minutes on Wednesday, and we have a series of data points in PMIs on Thursday. And this is a good proxy for GDP and overall consumer manufacturing sentiment across the board. Now, as I mentioned, there is a policy meeting for the ECB on Thursday as well. Something to keep tabs on to watch for the Euro. And of course, we have the symposium in Jackson Hole starting on Thursday and going through the weekend. And there will be many global elite there. And you could say that this is scheduled event risk. Now, it isn't quite known yet in the media, but Powell has set a media blackout for the Federal Reserve. So even though we are expecting a 100% rate cut in September, he is doing his best to avoid causing any reactions in the coming days. Number 3, sentiment. Sentiment is an important element to my qualifications. If retail sentiment is bearish, that tells me that a large crowd of people are receiving financial media and information that is concerning them. And I'm not going to get into how I trade sentiment, but all I can say is that I take a contrarian view to the crowd. And that is it. Thank you for listening, and I hope you all have a great trading session.